Stocks, bonds, ETFs, straight out of downtown Chicago. This is Zacks Market Edge.
Welcome to Zacks Market Edge, the podcast about investing in your life. I'm your host, Tracy Reineck, and this week I'm joined by John Blank, Zacks Chief Equity Strategist, who's here with us in Chicago to join us on the podcast. And we're going to talk about a topic that I'm kind of surprised I haven't yet covered on the show, which is housing, because I have a big interest in it, as everyone here at Zacks knows. I always am bringing it up, either it's China or Vancouver or even domestic U.S., but we actually haven't covered it yet. And I'm glad to have John on today because he has very insightful views on what's going on in Los Angeles, because he's been involved in a lot of the development that's been going on there. And I'm probably basically going to cover what's happening here in Chicago, but what is going on U.S. domestic housing market can be played out across the country. So, John, welcome today.
Hey, Tracy, thank you.
Yeah, I was looking up some of the stats, and I'll just give some of those out for those who aren't aware. There are 44 towers under construction right now in Chicago. Some are commercial buildings, some are hotels, and then you have the residential, both condo and apartments. They are building, let me see, I wrote it down, 8,377 more apartments under construction right now. And then another 3,800 are expected to be completed in 2018. So, and they built, I don't even know, it was like 4,000 or 5,000 last year. So there's thousands of these luxury apartments being built in basically every major city. In Texas, there's 69,000 being built in Dallas, Austin, Houston, and San Antonio. Across the U.S., I saw this number. There's 320,000 new apartments being built. That includes the low rises and, not necessarily just high rises. That's up 50% from last year. But occupancy still 96%, so that doesn't sound so bad. But rents are at all-time highs. In June, they averaged a little over $1,200. But as many who are in major cities know, they're averaging much, much higher. Even here in Chicago, they're about $3 a square foot for the most luxurious buildings. And so if you got 1,000 square foot apartment, that's starting around 3,000, and then it goes up from there. And then I was looking at LA, because John, you and I have both talked about that. And they're building, wait a minute, I wrote that down somewhere here too. It's, I think, over 6,000. Yeah, 6,200 apartments just in the downtown in those high rises that are going in down there. And then they have some other big condo developments that are happening. A lot with the Chinese developers coming in there. So there's a $700 million mixed use project that's supposed to go in across from the Staples Center, apparently. That's going to be big. And then you and I were talking about this Greenland development that's like also from the Chinese. That's huge.
Yep, called Metropolis.
Yeah. And so that's going to add a whole bunch of condo towers, offices, all of this stuff. But they're paying the most for the land, the highest per square foot that anyone has seen in like the last couple of years. So with all this stuff going on, I mean, it's great for the economy. This creating all these jobs. They're building the huge Vista Tower here in Chicago. It's 93 stories. It's going to be condo plus hotel. And when they're done, it's going to be the third tallest building here in Chicago. That's expected to create 2,000 jobs just to construct the thing, and then another 500 when it's done. So you can't complain about all this, but I'm getting a little nervous with the sheer number of these really expensive high rises that are going up for apartments. And yeah, the occupancy rates seem okay right now, but where are all the renters for these places? Should I be nervous?
Well, I mean, the thing we don't have here is the baseline break-even rental price.
Right.
And the reason we don't know that is this being constructed for the prices in the market, or is it being constructed with well understood 20% declines in these peaking prices? Because if you're thinking in a late stage developing context and you're smart enough, then maybe what you're quoting in these prices is not what you will get, and you know that. And you've baked it in, and your cost to rent is much lower, and you don't go belly up. You just, it's like going to Malibu on the weekend and you see hundreds and hundreds of real estate signs, and only 5 properties a month really turn. But why not put one out?
Right.
Why not see if I can get $5 million for my house? So the price, and this is a real estate fact. I mean, the price to list price and the closing price are never the same. So, but what we don't know is the cost to build and rent.
Right.
The baked in cost to build and rent. And the only thing that's bullish is the interest rates are super low. Wage rates really haven't gone up for construction workers that much. So if rents have gone up as much as they have, and these costs really haven't gone up that much yet, then you say to yourself, list it at a high rate. Yeah. And sure, I won't get it, but I don't need to get more than 2.5 a square foot in Chicago, really, or maybe it's 2. So the problem with our analysis, whether we're bullish or bearish, we don't know what break even is.
Okay, so all these towers, let's take Los Angeles. Obviously, there's a need for housing there, or everybody keeps saying, we need more housing, we need more housing. So now they're building, a dozen or so high rises in the downtown, which has the land. So why not? And now there's some better infrastructure with that light rail that's gone in down there.
The thing about Los Angeles different than Chicago is, I call it the Las Vegas vacation of downtown. I mean, LA's downtown was forgotten probably 50 years ago. And a good chunk of it is this place called Skid Row. Now, if you go to the bus station maps in Chicago, they tell you where everything is, and they have labels for everything. In LA, they have tell you for everything is, and there's a big chunk that's left blank because that's called Skid Row.
And that's downtown.
And that's 5 blocks from Staples Center. I mean, Kobe Bryant used to walk over to Skid Row after games. That's how close it is.
Yeah.
So you're talking about an area that the name Skid Row was born 5 blocks away. So downtown, the thing about LA is the downtown was far more run down and far more depopulated than Chicago ever thought of being, because no one who lives in LA to live downtown.
Right.
So the Las Vegas vacation of downtown, where you put in the entertainment and you have restaurants and shiny metallic looking buildings, is the big idea. So I think LA probably can do these things. I have more concern about Chicago, because I say to myself, I don't see Chicago having changed enough to absorb all this stuff. In LA, the downtown was a complete train wreck, and now it's not. Right?
But what are the jobs? Like, what are the people doing who are moving into those shiny towers in downtown LA? There's a law firms and things like that down there, but are they hiring enough people?
This is the issue, and that's the bear case. The bear case is that this thing is totally subscribed to people who are Chinese investors who will buy tax-sheltered investments, right? I mean, the bottom line with a lot of this stuff is, and you see it in New York already, I mean, people talk about, I've talked to people in New York, they'll say, everything's luxury. Every condo's luxury. And they're all bought. And they're all empty, and the lights are off, because what this is Russian money, Chinese money, Brazilian money, and they want it out of their countries because these currencies are collapsing, some of the economies are tanking, or they're just worried about the government taking it from them. So they say to themselves, I just want to park it, and what is better than to say my cousin is going to school at NYU?
Right.
My brother is a movie director. No, and then 5 and 10 of his cousins are also movie directors. I have a ton of movie friends. So I bought all these real estate properties in LA because I can't, on my taxes, put renminbi denominated bonds offshore, right? But I have a ton of cousins that are in the movie business.
So I did see a stat in one of the articles about all the buildings in downtown LA that said that for the condo part of them, they expect about 40% of the buyers to be Chinese down there. And here in Chicago, the Vista Tower they just broke ground on, that I was talking about, that's going to be, the 3rd tallest building, that in the condo portion, they've sold about 20% of the units, but it's unclear how many of those. They start at 1 million and go up from there. But that it's like 400 or 500 units, I think. So 20% is still, almost, it's like 60 or 70 of them have sold already. And so I don't know what the mix is there, but I'm assuming that they're marketing it heavily in Asia as well.
Yeah, well, I mean, again, the idea that you can't do it, we'll find out. But
But
you
what
know,
about the rentals then? Like what I mean they can build those and leave them empty too, I guess. But why would you want to? And are we going to see a crash in the rental prices eventually? Just supply and demand. You're starting in San Francisco. I've read that there's a little bit of softening because they've built, 10,000 units or something in San Francisco suddenly.
well, the way I describe LA to you is the real appeal of LA was it wasn't Chicago and it wasn't New York in the sense that there was no stackable living. Like,
Right.
The language in the street is people are stacked in cities like this, right? So if you look at my street's a good example of this. The 1970s little apartments are 2 flats. I live in a 4 flat on the second floor of a 4 flat. There's a building R3, which is not to be confused with R1 and R2 next to it, right? R3 is 8 stories.
Wow. That's tall.
It's tall. And a lot of these things in Culver City around the Expo line are 6 to 8 stories. So LA is moving into the kind of a West Loop level of stackable life.
Yeah.
And it's clustering around these nodes. So this is, and some people say this is totally unacceptable because our appeal was, room for your backyard and your truck in the front yard, and you had a single family detached house with some good weather, and you didn't have to live in a 20-story high rise in Chicago with crummy weather. So LA is slowly creeping up in its stackableness. And again, if you look at my neighborhood, these 2 flats, and LA has just reams of them because they're filled with the Mexican worker people. They're crummy. I mean, the Clippers and the Lakers were built by huge 2-flat landlords who had tens of thousands of units, and all this stuff is crummy. All needs to be torn down. So in the sense of an obsolescence cycle, I think LA is, because there's this thing called long waves in economics. There's short waves and there are long waves. Long waves are amortization cycles, where buildings have 30 years life cycles, right? And you amortize for 20 to 30 years. That's a accounting fact. But it's around the idea that buildings wear out. And I have more confidence in LA that there's just this long cycle going on. I mean, the downtown, they could tear it all down and rebuild it all.
Okay.
Right? Here in Chicago, I have a different view. I mean, I was just down in River North, and I was thinking how square and blocky and unattractive a lot of the buildings are. They're all about 25 years old. I mean, the reason there's what you think about is, when you look at a Frank Gehry building, and I was listening to Frank Gehry talk about his, he has constructed a house in Santa Monica that's sort of like, the Millennium Park thing with sweeping wings, but it was built before computers. So it's kind of weird looking. Right, there's a sheet metal and it goes off and weird, but it's all like handmade. It's like weird, right?
Yeah.
It's kind of like almost like a tree house, like a kid would make. And he said, I really couldn't put my ideas into play until the computer came along. Now, if you look at Aqua or Millennium or this new building, the Vista, they have a technical complexity that's remarkable, and that's all computer driven. So in River North, you look at all this stuff that's, again, 25 to 30-year-old, very square, draftsman from an architect with a piece of paper from the 80s or 90s before the computer took off. No CAD CAM, no real sophistication where you can put these really cool mathematical algorithms that tell you the stress of a really weird-looking look.
Yeah.
And now you get Aqua.
Right. That's a round building for those who don't know.
Right. And then there's weird, irregular walls.
Looks like water.
Every room's different, and it's super. But because you could do it mathematically, you just say, I just want every room different. So you set the model up and it runs through the system and you do the stress tests. So again, I mean, the way it's exciting from a building perspective, because these are new and interesting buildings. And you have to ask yourself, again, the long wave question, how many River North buildings, if the real problem is in these middle, it's like the suburb problem. If you're a new suburb and it's new building is great. If you're the city, you're great. But if you're in these first ring of suburbs that were built in the 60s and 70s, they're being emptied. And I think the same in River North. I think that if I'm worried about a 25-year-old property that I'm selling at a luxury rate that is totally obsolete, right? I mean, you see this
Well,
across.
it isn't. It isn't. They have been renovating a lot of
Right.
those B level properties because they do have to try to compete with the A levels and at those rates and what the amenities and other things that the renters want. And they did have these older properties, but they can't add a rock climbing wall because they don't have the space, but they can renovate at least the interiors of the units to try to get closer to what the newer buildings have.
Yeah, I'm down there. I looked at this. There was some kind of pool scene across the
yeah.
hotel I was at, and that pool scene was an '80s pool scene. The pool was really small, and it didn't look that cool. And I would have torn it out tomorrow. The types of pools that are available today.
It might have been a condo building.
Yeah,
I don't know.
But again, I think Chicago, because of its history. I mean, the hardest thing about all this stuff is we're talking about generalities and demand supply factors. And we just don't know enough of the economics
Right.
of the situations.
What about in Houston? They're building 20,000 apartments. They started them when everything was great in energy, and now it's not so great. And I've seen out of there, they're coming on the market now, and that is not a good place to be if you're a developer or landlord. And they've been offering 2-3 months free rent. So far, the rental prices are trying to hang on, but they do these weird methods, these incentives to make it seem like, oh, you're still paying $2,000 a month, but we'll give you 4 months free rent. And so it's really a lot lower. But what happens down there, like just as an investor, could we see some of these big apartment REITs, get into some trouble when you have like certain areas that can't rent these out?
Well, you think about what's going to happen. The REITs turn off a 6 or 7% return in cash, right? So what would happen is those returns would go to 3.5.
Yeah, well, I looked up some of the REITs just out of curiosity because I haven't looked at that area in a long time.
Yeah.
And the returns are not good. Like even now, I think they've just been bid up too much. So it's not even because things have gone bad, but it's just they're expensive. So I looked up Equity Residential. They're one of the largest ones. They have 85,000 apartments in like all the major cities. I'm not sure they're actually in Texas, to be honest, but they have the stock has a forward PE of 21 and its dividend is only 3%. And I was looking at that going, well, why would I need to buy this? Not for the dividend. And it's trading at 21 times. What's in it for me? That's not that good. I can find plenty of stocks paying 3%. So that one wasn't that great. I looked at Avalon Bay. In full disclosure, I used to rent in Avalon Bay in California. We won't go there, but they have a PE of 21 times as well and a 3.1% dividend yield. I looked up another one, UDR, not as familiar with them. They have 51,000 apartment buildings. Their dividend is 3.4. They're trading about 20 times. And then Essex Property, they're only on the West Coast. They're out by you, all the way up to Seattle. Again, trading at 20 times, dividend 2.9. So I was like, meh, about all of these. And then if you add in like this danger of overbuilding, why do I want to be in any of these as an investor? Would you want to be in them?
No, it's a sell the REITs.
Okay,
right?
That's what I think. I think they're too pricey and you don't get enough of yield for the risk.
Sell the REITs.
Okay.
Sell the REITs. I mean, because you think about it, there's nothing available for you that you already don't have. You have pricing that's going nowhere but soft at best.
Right.
Rates will certainly go up at this late of the cycle for sure. And you have this really big problem right now, which is a shock. The way you get killed here is not secular stuff, moves in cyclical. It's a shock like we had in 2008, but different. Like Trump gets elected. The peso blows up. The trade thing is huge. The economy tanks. If you have all these things online, they're going to go in half.
Yeah, I wouldn't
want
to own all those high rises.
Yeah, and so happening. This is the shock issue where it's big enough that it hits everybody. You can stand up to, Amazon taking over some athletic supply stores and, certain types of jobs becoming obsolete in certain parts of certain cities because your portfolio is big enough. All these REITs have played this hand really well.
Yeah.
The one thing they cannot avoid for sure is a shock, right? And that's when you're overpriced and you're only offering a 3% dividend rate and you're at this stage in the cycle where the one thing that's not on the table is a shock. And you don't even have to have one. You can have the threat of one to take these things down 40%.
Yeah. What do you think about the home rental companies? I looked up some of those. I haven't looked at them for years either. One is American Homes for Rent. And they're trading at 22 times. They pay a small dividend of just about 1%, but they are expected to grow earnings by 34% this year. So this is a little different than the apartments. So they own the single family homes and they've been renting those out. And then a second one is Colony Starwood Homes. They just merged, I think. They are trading about 19 times. They said they had a total occupancy of 95%. And that they see the strong demand for these rental homes and that there's short supply and they see everything as stable and great, basically.
Well, the housing starts, Tracy, right now, 1.2 million.
Yeah.
Employment growth of 1% on a population that works of 150 million with, 2 people sharing a house with their kids who don't work. 1.5 million is the number. So if we're only building 1.2 million, the housing market is still undersupplied.
Okay.
So there's the answer there is we still have ways to go to get to a level of recovery because Dodd-Frank cranked up all the mortgage variables. So it's tougher to get a loan.
It's a lot
right?
harder now.
And the 1.2 million tells you that we're still 300,000 less. So it's still room to run with residential. The other problem with residential, having worked in it with Bob Schiller years ago at the Merck, they put his futures on the Merck. The one thing I've learned is the housing futures in the Merck are worthless for any given one person's house. Which what I mean by that is no matter whether a bull or bear market's coming for housing, single family detached housing, it bears no reference and you cannot hedge for your given single house.
Okay.
The reason for that is, for example, I have a condo in Chicago that will be 1.5 blocks from the new McDonald's headquarters in
Right.
2019. What is the chance in 2019, even with a shock, that I won't make more money on my condo? Very little.
Right. That's
So
all location.
It's all location. So
Yeah.
when you get into, I met some guys who do appraisal automation of data on appraisals to set prices. The model, what's called a hedonic model, the quality adjusted model for a house, is in the 50 to 100 variables. So if you're next to a school, a park, you have recently remodeled your backyard, you have the right materials, it's of a certain style. I mean, maybe you're in Andersonville and you have the one cool building that's in near the park. If that's factored in, your neighborhood can go in the tank and you will still be okay. So the problem is with the market being undersupplied because of Dodd-Frank constraints and versus the 1.5. The number you need is 1.5, right? I mean, just keep watching it. 1.5 not happening. We got a ways to go. So the bottom line is residential housing, interestingly enough, is where the problems aren't.
Okay.
And don't ever have anybody give you a conversation on housing and make any sense out of it for your personal situation. Right? And that's also good investment advice. You personally have knowledge of your neighborhood where you personally know where the value is for because you know the houses, the owners, the stories, the street, whether there's traffic on it.
Yeah.
I mean, if you can leverage this.
Yeah.
Because it's very idiosyncratic. It's very specific risk of pricing.
Right. So with the supply and demand still being out of balance and in favor of the demand side, do you like these like home rental companies that I just mentioned, American Homes or Colony Starwood? Would you be interested in investing in this kind of thing versus
I'm more interested. I'd have to, again, it would be.
You have to look at down into their numbers.
The problem here, as you know, Tracy, is these ETFs have come along with put all these real estates together. Now S&P has broken off the real estate S&P from the banks, which means more money will set up in more ETFs that will ignore the individual circumstances of these things. So the problem with any statement here is if these get baked into a REIT with the apartment REITs, they're going down with them.
Okay.
From an investor perspective, right?
Yeah.
But I think, again, I mean, if you want, this is one of these situations where actually buying a house is different than buying a house renter company.
Right.
And the true problems within these apartments, right? And in these commercial real estate plays that have broad, and this is what's interesting, broad real estate exposure where they're trying for this huge, broad, sweeping thing, and they'll get hit by a shock. Yeah. The whole thing goes down, and the problem there is that so LA goes down, and they'll take their Chicago units down too because their cash flow will get hurt everywhere.
Right.
and they'll start levering off buildings in Chicago to close out with New York, and they're all trying to sell out of the same door, and they're all too big, and they all go down. That can happen easily.
Okay. Well, that's definitely something to keep in mind if you're in this space, because I feel like a lot is going on with housing right now. We'll have to have another discussion in the future, where we can cover some of the international stuff, because there's some interesting things going on with the Canadian housing bubble, as I like to call it. Might be busting up there. Australia is having some issues now, so we'll do an international one at another date. But this was interesting about what's going on here in the U.S., but it's something all investors should keep in mind, especially if they have any exposure to those apartments, as we were saying. And if you're interested in any of those REITs, or you just want to check them out, I'll give you the tickers here. Equity Residential is EQR. Avalon Bay is AVB. UDR is UDR. Essex Property is ESS. American Homes for Rent, that one is AMH. And then the Colony Starwood Homes is SFR. So definitely keep those on your radar, but it's not an area that John or I really like as investments right now. So if you want to read anything else, John has a lot of articles on Zacks.com. You should go over there and check them out. And also check out our prior podcasts. We did an interesting one on China, and we did one on Mexico and Colombia, but no one cared. But they will. They will care eventually when those are back in favor. And actually, both those stock markets have recovered quite a bit since we talked about it. So someone should have been listening to our podcast. But you can check those out. They're on iTunes and on SoundCloud, as will all of our other podcasts. So until next week, I'll see you then.